So now we can turn a little bit deeper into the U.S. economy, some of the data points that have come out that may help kind of adjust or protect some of these GDP assumptions. Now, just to go back to the coronavirus breakdown between manufacturing services, this is really going to start to come in here when we start looking at what's happening with the economic activity. And the one interesting thing is in the industrial production started to slow down, as you can see here. It hasn't been updated yet. It's coming out soon. And we'll get an indication of like what are some of these different components that will be drivers. The biggest thing is the economic index started to come down, which is why we're going to keep showing this chart, because the New York Fed has done a fairly good job of keeping tabs on what's happening within the weekly breakdowns. We did have some decent data that came out, which will help kind of support some of those Fed weekly economic indexes and should put it back to where it was prior to the dip. And the first one is really the ADP National Employment Report. We did beat estimates. So the estimates were about 649,000. Came in at 749,000. Chicago PMI came in at 62.4 versus 52. Again, nice, some positive attributes that came out. Another one that was interesting when we look at kind of what's happening on the employment report, the question is going to be how quickly can we close this gap? And when we look at the continuing claims, when we look at unemployment in terms of where it was last week, where it's expected to be this week, this week we're expecting a decline of 850. We surprised to the upside by about 30,000 last week, and we just continue to see these continuing claims to be fairly sticky, which again, even though the ADP is showing some of that turnaround, the question is going to be how much are we stemming the tide? And when we look at Marathon, airlines, other energy companies, leisure companies, we continue to see layoffs getting announced. So again, even though we're getting some of this tick back, it still is going to weigh on just the general sentiment of how our customers or consumers feeling, because we did have a fairly big increase in consumer sentiment. And the question is going to be, is that too much of a look back? Because the consumer sentiment was looking a little bit further back. Things have changed a little bit in terms of COVID increases and now some new layoffs. So we expect some of that consumer confidence to wane, which would be another overhang. The other one that's interesting is pending home sales, which increased 8.8% month over month versus the survey of 3.1%. We're actually seeing some of these sales get delayed because either banks are asking for more proof of revenue, more job security. So we're actually seeing some of these delays, and if you look at Europe and some other places in the US, we're actually seeing some of the sales fall through because either financing is getting cut and or financing isn't actually closing. So again, these are some small things to look at that could put a little bit of weight on the mortgage side. The one that we always like to look at is what are central banks doing? So here you can see the central bank increases as a percentage of GDP, and we can see where the SNB, which is the Swiss National Bank, and where the Bank of Japan are in terms of just their aggressive backdrop of balance sheets versus GDP. But you can see the ECB and some of these others are starting to close that gap. The Fed is obviously doing its part. And if you think, or if you listen to some of the statements that were made by Fed chairmen and the Fed bankers, the backdrop is we need more stimulus. We need more of a fiscal response. And as headlines are coming across right now, McConnell keeps talking about how the two sides are too far apart, Republicans and Democrats, and it just seems unlikely that we're going to get any type of really fiscal tailwind. So it's really left to some of these central banks, which continue to try to stimulate. And as you can see, they have done so since essentially 2011, when you think of the BOJ, the SNB and just the ECB. So we continue to see the creep higher, and again, we've seen the outcomes, which has become inflation. So the question is now turning back to the U.S. What is the annualized inflation projection that we're continuing to see as we get closer and closer to this 5%? And again, closer to, I should say, 2% on our way to depending on how you weight it. And there's always going to be a question of what is the weighting on how you calculate inflation, because these are some of the seasonally adjusted price index. When we look at the 3-month average, And we have to consider what has happened. What are the impacts for inflation? Because I can point to multiple inflation projections, and then I can point to other offsetting deflationary sides. So the question is, which one really wins out? And it's one that we're going to go deeper, that we're going to take a deeper dive into that equation this weekend, looking at it from different angles and really kind of coming to a better conclusion to where we think things are going to go. One of the interesting comments is the stuff we want is obviously more expensive and the stuff we don't want is cheaper. So this comes back to the weightings of how people are consuming. So even though on a net level, based on the way the calculation is done, we may be below 2%. But when you start weighting things differently, you can start to see on how easy it is to creep closer to 5%. 4 to 5%. And just look at the general things that people are purchasing. Medical care. I mean, who doesn't have medical care right now? Who's really focused on making sure they have medical care? Rent or home. As we've seen home prices go up, as we've seen, this shortage really drive up those home prices. Food at home, again, coming down to that food inflation. We've been driving this home. We've been talking about it since COVID began, because food is where we can continue to see inflationary fears. We did a whole segment on it, looking at, what does that mean for food security, specifically in the U.S., how much money is being spent on food. And then to offset it, not surprising, food at work or school is getting cheaper. And that's, we look at restaurants, you're starting to see some of those creeps higher. But the stuff that we don't want is fairly simple if you consider what, how people have adjusted spending. And some of that makes a lot of sense. And again, but how much of that side of the equation was really impactful to the actual inflation calculation, where if you look on the left of stuff that we want is getting more expensive, this was already a big part of consumption and it's only getting bigger. I can speak personally where I can say that essentially my mortgage and my healthcare is the same price, but yet they're not weighted the same if you look at the backdrop. And if you consider how other people spend, I'm not alone in that statement, in that sentiment, and that's going to be an overall weight when you consider inflation. Now, when you start to see market implied inflation and then some characteristics, like BlackRock here is more aggressive where they think inflation is going to play out closer to that 2.7%. 2.8%, and you see Morgan Stanley, Goldman Sachs, all guiding to an increase in inflation. And the question is going to be, what wins out? What is it going to be? The inflationary pressures? Will there be enough deflationary pressures coming in? And again, that's where we start to see some of that deflationary that's going to come through, especially on the school side. But the inflation remains there. It's going to be a bigger problem, but we could do hours on where inflation, deflation plays out, given how central banks have acted. So we're going to try to dedicate a bit more time to the different inputs to that side. But the sharp increases in expectations continue to go. And if you just break it down to raw materials, like we've talked about lumber in the past, we continue to see it in nickel, copper. But when you look at nickel and copper, you also have to consider that there is a supply disruption, because a lot of these different countries, whether that be Chile, other Latin American entities, South Africa, Africa in general, they had their own COVID issues. We've had supply chain issues. We've had mines shut down. So that inherently essentially cut a significant amount of supply. Even though demand dropped, the supply dropped faster. And that caused some increases in price. And then obviously when you have new homes being built, new home permits, that pulls a lot of copper through the system. So again, these are where we start to see some of this inflation. We now, as some of the mines come back online, we're starting to see some of the pressure in pricing come back in. Prices are getting softer, but gold is the one that has been the tell. Whereas the dollar weakens, gold goes higher. Right now we have, essentially the dollar flat. We think it goes we think the dollar is going to move higher, something closer over 95, just given the pressures, which is why we remain concerned about the emerging market space. Now, when we look at gold, it's important to look at, okay, well, what are the exports doing? Where are they going? And you see more and more gold being diverted to the U.S., and it's important to appreciate why. When you think of the consumer wanting more protection on the, whether it's a bullion, whether it's through contracts, whether it's through GLD, which is an ETF that gives you fractional shares, there's more and more consumption or concern where gold is becoming a much bigger part of the portfolios. And you can see how China has really dropped off and the rest of the world, because if you think China and Russia and actually Turkey have been bigger buyers, but as the consumption and now China and India have a very large gold trades, especially India, when you think about wedding season, has really started to drop off. And we're seeing more come into the US as people looked at it to diversify and start to protect from the actions of Powell, as we saw this massive stimulus that really started in March, this uncertainty about the fiscal stimulus, uncertainty about what's going to happen with the presidential election. Gold is an easy answer, and that's where we're starting to see more of those flows come through. And it's not, and this is going to be one of those counter deflation, more of a deflationary side. So if you think about what the Fed has purchased, because the Fed continues to buy different assets, continue to drive this, they've been a huge buyer of TIPS, which are just inflation adjusted. So they could be trying to give the view of inflation where people might look at this and say, oh man, like, look at the TIPS market. The TIPS market is it's showing that people are getting a lot of fear. They're getting fearful. There's a bigger expectation of inflation, where it could very much just be the Fed trying to give the appearance of inflation and trying to get some of that confidence back in. There's a lot happening here. USD inflation swap continues to creep higher. That's one that I think is a little bit of a better gauge in terms of trying to understand where things are. The 10-year, the generic 10-year, the Treasury 10-year has been more along the lines of very stable, just because there's a lot of supply. We're starting to see some of the pressure in duration, specifically in the 20-year and 30-year. And the 20-year, 30-year is going to give you a better indication of where people are assuming inflation is going to go over the longer term. But again, I think the swap is starting to give you some indications of, okay, well, yeah, there is a little bit more fear coming in, and it's something to keep tabs on. And the reason why, when you consider, well, what's going to happen? Why do we need more fiscal? All you have to do is start looking at bankruptcy filings. And we continue to talk about bankruptcy filings through Yelp data. Again, this one is through just Chapter 11, Chapter 7 filings. We're starting to see this huge uptick. And this is the third quarter was the worst on record. And that I don't think that's very surprising, as people try to last as long as they could. They are heading into Q4 and saying, look, we don't have the bandwidth to get there, especially without the fiscal backing to get people to the other side. So this is a much bigger problem when we start to think about jobs, when we start to think about, well, how are we going to get to the other side without a jobs backdrop, or at least a supportive jobs market? And when people get concerned about, well, who's going to spend, where are they going to spend, millennials continue to see a major impact. And again, always looking at different ways to pick apart data points, try to see if there's something there, because some of the near-term data or some of the leading indicators are a little bit better. We're starting to see some of those moves, specifically in employment changes, and some of the personal consumption wasn't as bad as expected. Chicago PMI was a little bit better. But as jobs continue to be lost, this is why at the very beginning we talked about how jobs could become a leading indicator, not a lagging indicator, given the sheer size and just those continuing claims that continue to ratchet up, especially when we have mortgage delinquencies going and increasing on 90-day mortgage delinquencies increasing. This pressure is mounting, and millennials are feeling the biggest brunt of that impact, which is why we're seeing more people stay at home, more people that are essentially saying, look, I don't have the ability to buy a home because I don't have the down payment. And if you consider the shift, as they are supposed to be the ones that start to spend more, have more discretionary cash, travel the most, if you consider who travels the most, this is going to be a big headwind as we head into what was hoped to be a V-shaped recovery, which we said was impossible from the beginning. But here we are. Now, when we talk about what businesses, where are the businesses closing, here you can see, I don't think there's any real surprise, considering that we have the shift from the urban to the suburban rural. So a lot of these companies just don't have the bandwidth, nor do they have just the clientele anymore, because people are avoiding those urban areas. So when we consider the urban areas, not only are people moving out, businesses are closing, again, tax revenue. This is a much bigger problem when we start considering the ramifications of municipalities, states that have to close that tax gap. And if, obviously you see California and New York top of the level, and if you consider the fact that they already have a huge tax bill, this is going to be a much bigger problem. And in the next segment, we're going to go a little bit deeper on who is closing, where is that being impacted, and what does that mean for not only hours worked, but for then the general job creation as we start to prepare for not only Q4, but as we look towards 2021.